Welcome to WealthEchelon, your go-to spot for smart investing, in-depth ETF insights, and book reviews that help you build wealth. On this channel, we explore everything from the best investment strategies to the latest trends in ETFs and provide valuable takeaways from books that can transform your financial journey. Whether you're a beginner or an experienced investor, our goal is to give you the knowledge you need to make informed decisions and grow your wealth. If you're ready to elevate your financial game, hit that subscribe button and don't forget to turn on the bell for updates on all our latest content. You've done the hardest part, saving $100,000. It's a significant milestone that many aspire to, but few achieve. That amount of money isn't just a number. It's the key to unlocking your financial goals, whether that's growing your wealth, generating income, or securing a comfortable retirement. However, the real challenge begins now, deciding how to invest that money wisely. Choosing the right investment vehicle can make a profound difference in your financial future. Among the vast sea of options, two exchange-traded funds, ETFs, have emerged as top contenders for investors seeking to harness the power of the U.S. stock market, 4V and SCHD. These ETFs are beloved by many because of their solid reputations, proven performance histories, and broad access to American companies. But while both represent the strength of the U.S. economy, they do so in fundamentally different ways. IVV tracks the S&P 500, a benchmark index made up of 500 of the largest U.S. companies, spanning sectors like technology, healthcare, finance, and consumer goods. This means when you invest in IVV, you're essentially buying a slice of America's biggest and most influential corporations. This fund leans heavily on capital appreciation, the increase in the value of your shares over time. It's designed for investors who want growth and are comfortable with the stock market's natural ups and downs. In contrast, SCHD is a dividend-focused ETF that prioritizes companies with strong financial health and a history of paying and increasing dividends consistently. Instead of just aiming for growth, SCHD puts emphasis on generating reliable income. This income can be especially appealing to investors looking for steady cash flow, whether for living expenses, reinvestment, or cushioning against market volatility. Given these distinct strategies, it's clear that IVV and SCHD serve different purposes in a portfolio. The decision of which one to invest in depends largely on your financial goals. Are you seeking aggressive growth or steady income? How much volatility can you tolerate? And how important is minimizing fees or taxes to your overall strategy? In the following sections, we will dive deeper into these factors, examining how each ETF builds wealth, their risk profiles, costs, tax implications, and which investor profile each best suits. By the end of this breakdown, you will have a clearer picture of which fund may be better suited to help you grow your $100,000 into the future you envision. Understanding IVV and SCHD, core differences in investment strategy. IVV, or the iShares Core S&P 500 ETF, is one of the largest and most widely held ETFs globally. Its mission is simple and powerful, to mirror the S&P 500 index, which tracks the 500 largest publicly traded companies in the United States. This means IVV essentially gives you ownership in America's biggest corporations, from tech giants like Apple and Microsoft to consumer staples like Procter & Gamble and healthcare leaders such as Johnson & Johnson. Because of its broad market coverage, IVV is considered a core holding for many investors aiming for long-term growth. SCHD, or the Schwab U.S. Dividend Equity ETF, takes a different approach. While it also invests in U.S. companies, SCHD focuses specifically on companies that consistently pay dividends and have strong fundamentals such as high return on equity, stable earnings growth, and solid dividend history. This ETF is designed to provide investors with a reliable and growing income stream, making it particularly attractive for those who want both growth and cash flow. Unlike IVV, which emphasizes market capitalization, SCHD emphasizes quality dividend-paying companies that may include some mid-sized firms, not just the giants. Growth potential versus dividend income. What matters more? One of the biggest differences between IVV and SCHD is how they build wealth for investors. IVV's strategy is to provide growth by owning the largest companies in the U.S. economy. Historically, the S&P 500 has delivered average annual returns of roughly 10% before inflation, driven largely by capital appreciation, meaning your shares become worth more over time. This makes IVV an excellent choice for investors who want to grow their wealth significantly over the long term and can tolerate the ups and downs of the stock market without needing regular income. SCHD, in contrast, focuses more on income generation through dividends. Dividends are payments companies make to shareholders, often representing a share of profits. SCHD targets companies with strong and reliable dividend payouts, which can be attractive for investors seeking steady cash flow, such as retirees or those wanting to reinvest dividends to compound returns. Over time, dividends also provide a cushion during market downturns since the income continues even if stock prices fall. While SCHD may not grow quite as aggressively as IVV during bull markets, the dividend income and often lower volatility can make it a more comfortable ride for some investors. Risk and volatility. How stable is your investment? When considering an investment, understanding risk and volatility is critical. IVV's focus on large-cap stocks means it generally represents the overall market's ups and downs. During economic booms, IVV can surge as big companies thrive. During recessions or corrections, these stocks can also see significant declines. The tech sector, which makes up a large portion of IVV, can introduce additional volatility. For investors with a longer time horizon and the ability to hold through market swings, IVV's risk profile is typically manageable. SCHD, by targeting dividend-paying companies with stable earnings and financial strength, tends to be less volatile. Dividend-paying companies often belong to sectors like utilities, consumer staples, and financials, which can hold up better during economic slowdowns. The regular dividend income provides some downside protection, and the ETF's focus on financial quality helps reduce exposure to highly speculative or unstable companies. While SCHD is not risk-free and can still fall during market downturns, many investors find its risk-return profile suits conservative or income-focused portfolios better than IVV. Fees, liquidity, and tax considerations. Cost and tax efficiency are key components in choosing an ETF, especially when investing $100,000 or more. IVV has an extremely low expense ratio, around 0.03%, meaning you pay just $3 annually for every $10,000 invested. This low cost is a major advantage and is part of why IVV is so popular. It also boasts high liquidity, with millions of shares traded daily, ensuring tight bid-ask spreads and easy trading at market prices. SCHD's expense ratio is slightly higher but still low, around 0.06%. The slightly higher fee reflects the more specialized screening and dividend-focused strategy. Liquidity for SCHD is also strong, though typically less than IVV, but still more than sufficient for most retail investors. Tax-wise, dividends from SCHD are typically qualified dividends, taxed at favorable rates compared to ordinary income. However, if you hold SCHD in a taxable account, you may owe taxes on dividends each year, which can reduce net returns unless you reinvest dividends or hold the ETF in a tax-advantaged account. Which ETF fits your investment goals? Ultimately, the choice between IVV and SCHD comes down to your personal financial goals, risk tolerance, and time horizon. If you're primarily seeking capital appreciation and are comfortable with market volatility, IVV is an excellent core holding that captures the broad growth of the U.S. economy. Its minimal fees and massive liquidity make it a solid, straightforward choice for most investors. On the other hand, if you want to generate income from your investment while still participating in stock market growth, SCHD offers a compelling balance. Its focus on quality dividend-paying stocks tends to reduce volatility and provide a steady cash flow, which can be reinvested or used as income. For retirees or those seeking a more conservative investment that still has growth potential, SCHD may be the better fit. Some investors choose to own both, using IVV as the growth engine and SCHD as the income generator, combining the best of both worlds. With $100,000, it's possible to diversify across both ETFs, Tailoring your allocation to your desired balance of growth versus income. Deciding between IVV and SCHD isn't about declaring a universal winner, because frankly, there isn't one. Both ETFs are excellent investment vehicles, but their true value depends on how well they fit with your unique financial goals, risk tolerance, and investment timeline. Investing is not a one-size-fits-all endeavor, and what works wonderfully for one person might not suit another's needs or preferences. IVV offers broad exposure to America's economic powerhouses, the largest, most influential companies that have driven innovation, shaped industries, and created massive wealth over decades. For investors who prioritize long-term capital appreciation, IVV provides a straightforward way to capture the growth of the U.S. stock market as a whole. It's ideal for those who can stay patient during market swings, who want their money to compound over many years, and who aim to build significant wealth through price appreciation. On the other hand, SCHD caters to investors who value consistency and income. Its focus on financially strong companies that pay dependable, growing dividends means it delivers not only growth, but also a tangible stream of cash flow. This makes SCHD appealing to retirees or anyone seeking to supplement their income without selling shares. The dividend income can also act as a buffer in turbulent markets, potentially reducing volatility and emotional stress. Its emphasis on quality can also provide an element of stability in uncertain times. Both ETFs come with their own trade-offs in terms of growth potential, volatility, and income, and understanding these nuances is key to aligning your investments with your broader financial plan. For many investors, a blended approach, allocating funds to both IVV and SCHD, can provide diversification benefits, combining the best of growth and income strategies. Ultimately, investing your $100,000 wisely is a powerful and proactive step toward financial security and freedom. By taking the time to thoroughly understand how IVV and SCHD operate, you empower yourself to make confident, informed choices that reflect your personal goals. The right decision today could be the foundation of a prosperous financial future, helping your money grow and serve you well for years to come. Remember, successful investing isn't just about picking the best ETF. It's about finding the one that fits your unique journey and keeps you invested through the highs and lows of the market. Thank you for watching Wealth Echelon. We hope you found valuable insights that will help you on your investing journey. If you enjoyed the video, make sure to hit the like button, subscribe, and turn on the notification bell so you never miss an update. Keep building your wealth, and we'll see you in the next video. Don't forget to check out our other videos for more investing tips, ETF strategies, and book reviews to continue growing your financial knowledge.